Okay, so it's 14:31. Let's start. So hello, welcome to this second half day of the workshop on Directors' Duties and Sustainable Corporate Governance. My name is Marco Becht and I'm the Executive Director of ECGI, and I'm here with Luca Enriquez to moderate the day today. So yesterday Luca started, today I'll start, and yesterday I did the summing up. Today Luca will do that. So to start with, I'll provide you with a quick recap of what we already discussed yesterday and provide a short introduction. That should last for about 10 minutes. And we then move straight away to presentations from the ECGI research members who submitted written responses to the European Commission consultation on the EY report. Then we have a little break, and then we are going to have another panel to discuss the issues further. So let me start with a short recap. And for those who were here yesterday, a slight repetition of the introduction from yesterday, but since not everybody was here yesterday, I thought we might just, like in every good series, do a small recap of what was already said. So the first question is, how did we get here? And you have to go back to 2016 to the Sustainable Development Goals and the Paris Climate Agreement. What was the European Union's response? Well, in the area of finance, the response was to say, well, we have to do something about sustainable finance. And a high-level group was created. And then the high-level group delivered a report. And then very quickly, the European Commission came up with an action plan to actually implement the recommendations it thought from the group it thought worthy in terms of actions. And the action that's concerning us today, or the origin of what we're discussing today, is Action 10 in the action plan, fostering sustainable corporate governance, attenuating short-termism in capital markets. So the high-level group and the Commission at the time already identified what they thought was the main concern or the main link between corporate governance, capital markets, and the goals that are outlined before, which is short-termism. And then the European supervisory authorities, we asked for reports, and also other stakeholders were being consulted, and 2 reports were commissioned of one of the reports we're going to discuss today. So this is where we are in the process at the moment. The red bit is the report, the study on director duties and sustainable corporate governance that we are going to discuss today. There was a consultation on it which closed in October. So that's the submissions we are going to hear in a minute. And in parallel, there are other consultations that are going on. So first of all, there was a consultation on the renewed sustainable finance strategy that also contained questions about corporate governance. And there was another study on supply chains. And at the moment, there's another consultation going on, which uses input from all 3 elements and asks other questions, which is going to go until the 8th of February 2020. Now, the European Commission has already announced in its 2021 work program that it is planning to initiate a legislative proposal in the 2nd quarter of 2021 on sustainable corporate governance. So in particular, the work program says legislation on sustainable corporate governance will be proposed to foster long-term sustainable and responsible corporate behavior. Now, in terms of the report, we already introduced the report yesterday. So first of all, there's a first part, which is about what's the evidence for short-termism. And then there's a second part, which goes through the various policy options. And as I explained yesterday, the report identifies 7 drivers, 12 issues, and lays out 36 policy options in great detail. And this, of course, is then going to feed into the Commission's thinking. Now, if you like to look at this in terms of a timeline, and I'd like to thank EY for providing me with this very helpful timeline, 2018 is what I just explained to you before, the action plan, Action 10, then the European supervisory authorities delivered their reports in December 2019. We had the study on due diligence requirements in February 2020. In July this year, we had the EY report, which we are discussing today. And what's going on in parallel is that the Commission internally is preparing an impact assessment, which it needs to do whenever it wants to prepare legislation. So everything we are doing here is potentially going to go into this impact assessment. And of course, there's a feedback period, and there's also going to be a public consultation on the impact assessment. And then in 2021, Q2, we will see what the actual outcome of this is in terms of any legislation or directive that might or might not be proposed. Now, turning to the substance, I think yesterday we had one broad conclusion, which was that short-termism is, of course, not the only item that is being discussed in corporate governance and stewardship that relates to the policy objectives, namely the Sustainable Development Goals and the Paris Climate Agreement. But if you look at the wider Commission program, also making the European market economy work for people. So issues like inequality and other issues that people are concerned about when they talk about capitalism today. So the broader issues include stakeholder capitalism, enlightened shareholder value, and we heard from Oren Sussman yesterday a plea that maybe the European trading scheme and the carbon tax might be the way to go about it. And then if you believe in enlightened shareholder value, then actually the pricing mechanism can take care of all of this, and we actually don't need to reform corporate governance very much. Now, if you think that's outlandish, we actually have at a conference with ESA last week where Bengt Holmström, who did receive a Nobel Prize in 2016, very much argued for option 3. We, of course, are debating responsible investment. We heard about this yesterday. There is PRI. We have Climate Action 100. Is that short-termism? Is really maybe something parallel, responsible banking, corporate purpose, and so forth. Now, to be true to what we set out to do, we're not going to discuss, well, maybe we are, 1 to 6, but our focus really is short-termism, and we had a definition of it yesterday from Zacharias Sautner, who put up this map. So I'll leave it with you. Zacharias put the CEO at the center of things. So the CEO is in charge of execution. And then there are things that influence the CEO, reporting, analysts, but also shareholders, activists, and other considerations. There is engagement, there are incentives. So all these things feed into this. And then, of course, there is the behavior. And he told us about the behavior. So R&D, CapEx, buybacks. But then the question, of course, is, is that behavior, what behavior do you need to look at in order to capture what we're trying to capture, namely the sustainability goals? So that's the kind of map Zacharias laid out for us yesterday. And we will continue to investigate this today. And we are going to go, yesterday we had a break after the introduction, today we don't. We have a break after the first panel, and I propose that we move straight on to the first set of respondents to the European Commission consultation. And we will first hear from Paul Davies, who is a professor at the University of Oxford, and then from Mark Rowan and Holger Sparmann, who are at Harvard Law School. And I think we start with you, Paul.
Thank you very much. So, thank you. Let me see, first of all, hello everybody, wherever you are and whatever time of day it is. Let me first of all try and share my screen with you. Okay, so I've been invited to make this short presentation because I'm a member of the self-styled European Company Law Experts Group, which put a response to the EY report on the Commission's website. And I've put the first sentence from that response on the slide, so you can see what our general line of criticism was. Now, that was a short response because the Commission gave one only 4,000 characters to use for the response, not 4,000 words, 4,000 characters. And so in a sense, it's tempting for me to use the time I've got available to me to expand on what the Eckley group said. But in fact, I'm not proposing to do that, because what we said as a group is echoed by a large number of other respondents, and they, or some of them at least, have developed their views into self-standing papers outside the Commission's response website, and they're well represented in this conference. So what I thought I would do is move on to make some remarks about the second stage in the Commission's pre-legislative preparation, namely the consultation paper, which Marco referred to. Now, let me, right, yeah. So the consultation document. Now, given the weight of the criticisms that were directed against the EY report, you might have thought that the Commission would take pause for thought before moving on to the second stage, but there was no pause, as you can see from, well, Marco's timeline and from what I put on this slide. The period for reactions to the EY report ended on the 8th of July. On the 26th of July, the Commission had already produced its consultation document on sustainable corporate governance. There's no mention in this consultation document of the initial adverse reactions to the EY report. All we're told is that the consultation document builds on the data collected in the EY report, which of course is now heavily controverted both for its relevance and interpretation. So there was no pause, and as far as one can see, no thought either. Now, the structure of the consultation document, I think, is really unlikely to fit the purpose for which the consultation document is aimed, in the sense that I don't think it will reveal the full range of views which are held in this very complex area. Essentially, the consultation document proceeds after a very short narrative introduction with a series of yes-no questions. It's true you can be more strongly yes or more strongly no, but essentially it's yes-no. There's a little box underneath each question in which you can add a bit of narrative explanation, but it's unclear to me how much. And anyway, we know from previous experience that when the Commission presents the results of these types of consultation documents, it focuses on the yes-no answers. And my worry is that a yes-no approach is, as I say, unlikely to reveal the full range of views which are in fact held by the consultees. Now, given this approach in the consultation document, you would have thought that those framing it would have taken steps to make sure that their questions were formulated in such a way as to allow the appropriate answers to come out for people to express their views. But it seems to me that they have not done this really, and certainly not across the board. Let me give you two examples. Here is question A. Do you believe that corporate directors should balance the interests of all stakeholders instead of focusing on the short-term financial interest of shareholders, and that this should be clarified in legislation as part of the director's duty of care? Now, suppose you're a person, and a number of people take this view, who thinks that the best approach in this area to advance overall social welfare is for directors to concentrate on the long-term interests of shareholders. Now, how exactly do you answer this question if that's your view? If you say yes to this question, that implies that you take a stakeholder approach. If you answer no, it implies you favor a focus on short-term shareholder value. Neither is what you believe, so your view is hidden. Or suppose you do take a stakeholders approach, but you think that a reformulation of directors' duties is not the best way to achieve stakeholderism. I don't know how you answer this question in that case either. So this is a situation in which the Commission has bundled up into a single question, two questions which ought to have been kept separate. Here's another example. As companies often do not have a strategic orientation on sustainable risk, blah, 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 do you believe that such considerations should be integrated into the company's strategy, decisions, and oversight within the company? Now, how do you answer this question if you disagree with its factual predicate, which I know many senior managers in large companies do? So it's a yes-no approach with this risk of hiding views and with the questions not well formulated so as to allow people to express their views. When I was a young lecturer, which of course was many decades ago now, I attended a course on social survey questionnaires. And we were given an example of a question which shows you how not to formulate these questions. And let me commend this example to those in the Commission responsible for this questionnaire. The question is, in the questionnaire, have you stopped beating your dog? Now, if you answer yes, that implies that you beat your dog in the past but have now stopped. If you answer no, it implies you're still beating your dog. If you've never beaten your dog, then the question is simply a trap. Okay. So turning now from the formulation of the consultation document to some of the substantive issues. Here I think I want to make 3 points, and I think they're actually simply re-emphasizing points that were made yesterday. The first is that a lot of the proposals in the EY report and thus in the consultation document seem to be addressing symptoms, not causes. So take the core proposal in the EY report, which is to reformulate the current core duty of directors, which is typically to act in the way that they consider is in the best interests of the company. So that the proposal is should be reformulated so as to require directors to act in the interests of a range of stakeholders. Now, the EY report, and therefore presumably the consultation document, accepts that the director's current duty of loyalty does not require directors to focus on short-term gain for shareholders. There's no jurisdiction in the world that I know of that across the board requires that to happen. So if you're aiming at steering directors away from short-termism, it's not clear why you're focusing on the director's current duty of loyalty. Well, the answer that we're given in the EY report is that it's not that the law requires managers to do this, but they understand the law to be doing this, to require them to act in this way. And so the solution, it's suggested, is explicitly to build in stakeholder interests and the environment into the core duty. But the issue of how one gets from statement 2 to statement 3 seems to me to raise a number of issues which are underexplored in the EY report and the consultation document. It seems to me it would be really helpful to try and explore and understand what drives this allegedly erroneous interpretation of the core duty of loyalty by directors. And if one focuses on that, well, two reasons for doing it, sort of Morton's fork, really. If you don't focus on what these other pressures are, which lead to directors taking this narrow view of their legal duties, there is a risk that having changed the law, the directors simply carry on as before because the pressures are still in place. Alternatively, if you do successfully address the pressures on directors and they depart from a short-term view, then maybe it will be unnecessary to change the core duty of loyalty from its current formulation. But that issue is not really explored at any great length in the EY report. Now, to do the report justice, it does suggest one type of pressure which may be leading to this misinterpretation of the core duty of loyalty by directors. And they refer to the growing pressure from investors for short-term results. The question is that true? Now, 4 years ago, a bit less actually, the Commission clearly didn't think it was true. There is recital 14 from the amendments to the Shareholder Rights Directive adopted by the EU in 2017, which is clearly saying that investors are part of the solution, not part of the problem. They can help improve the financial and non-financial performance of companies, including as regards environmental, social, and governance. And as we know since then, the ESG investing has continued on the rise. So there's a recent report from the OECD which makes this point very strongly. So what's the position? Was the Commission right in 2017 and wrong now? Or is it the other way around? But the answer is probably neither. That the question of the interrelationship between investors and managerial behavior is actually much more complex than the slogan of growing pressure from investors really allows us to grasp. So it may be, I would have thought, pretty well obviously clear that one should disaggregate the category investors and look at different types of investors and see what attitudes, analyze what attitudes they have towards the time frame in which they're seeking paybacks for their investments. And at the bottom of the slide are just a few rather obvious categories of investors one might wish to look at. Then my third point, Marco, how long have I got? Can you tell me? I'm pleased to say that when I put my screen on, the time disappears. Anyway, I'll continue. I'm very strongly in favor of what Oren Sussman said yesterday, which was essentially that there's a really big issue which is not explored in the EY report or the consultation document, which is the balance between internal corporate governance and external regulation for dealing with corporate externalities, in particular the impacts of business behavior on the environment. Now, obviously, company law can do some things here, especially in the area of disclosure, but it seems to me clear that regulation has some big advantages over corporate governance reform, namely that it addresses more effectively the coordination problems of private actors. And it also has more legitimacy in handling distributional conflicts. And some people are going to lose out, have lost out already as a result of steps taken to reduce the impact of our human activities on the environment. And I would prefer, in my rather old-fashioned way, those decisions to be taken by elected politicians rather than by the boards of private companies, no matter how inclusively those boards are composed. And of course, if one does that, the third advantage is that this limits the task to be performed by corporate governance rules and increases the likelihood that those rules will operate to increase the operational efficiency of companies, which is in itself an environmental benefit. So my conclusion is that neither the EY report nor the Commission consultation is a basis for sustainable corporate law or corporate governance reform. I find this deeply depressing because both short-termism and the impact of business activities on the environment are very serious problems, which deserve, in my view, a more sophisticated analysis and response than they've been given by the Commission. My only hope is that somewhere else in the EU legislative process, other actors will open up the debate. Thank you very much.
Thank you very much, Paul. So, well, we could have a 10-minute discussion of what you said, but we'll turn straight away to Mark Rowe and to Holger Sparmann. Thank you.
Thank you. Thank you very much. You should hear me and you should see our initial slide. Good. Holger, Jesse Fried, and Charlie Wong and I put together a submission to the EU on the EY report, and we've got to thank Luca and Marco for prodding us in that ECGI email to do that, because we were talking, we would talk about this and maybe fulminate, but we probably wouldn't have written something had you guys not sent us something with a bit of a push. Our tone is kind of similar to Paul Davies' tone. If it's possible to be more negative, maybe we are more negative on the EY report than even Paul was. So let me tell you the structure and of our comments. 4 things that seem to be wrong, some of which have been discussed already. It conflates time horizon problems with other problems, pushes them all together. It fails to measure the buyback problem properly, which Jesse's going to talk about in a few minutes. It misuses the prevailing academic literature, and it really fails to consider the costs of the potential cures that it's thinking about, something that Holger's going to talk about in a few minutes. Each one of these would be a big problem. Put them all together, and our view is that the EU should reject the EY report, and if it's serious about the program that it's starting to pursue, it should commission new work in the area. So the conflation problem. Some of this has already been dealt with, but there are a few more things that are probably worth saying. Short-term problems in the corporation are not externality problems, and the report squeezes these together. And it squeezes these together in ways that can confuse the policy-making response. So Royal Dutch Shell, BP, Total, they're actually quite long-term operations with significant parts of the planning structure in the firm thinking about what we're going to do about hydrocarbons in the 2040s and the 2050s. And to just put a little bit of an edge in this, we wouldn't say that pollution is okay and hydrocarbon burning is okay if it's a 30-year policy and it's only a problem because it's a short-term shareholder profit oriented policy. The problem is actually more severe if it's long-term than if it's short-term. And as has been said, and we'll just repeat, it's really no substitute for a carbon tax. If we fix the time horizon problem, if there is one in the large corporation, we're still going to have an externality problem. And without curing the externality problem, we're probably not going to cure the global warming and related problem. What's more is by grouping purpose issues, stakeholder issues, and externality issues into one lump, and I've written on this elsewhere, by putting them into one lump, we tend to see more time horizon problems than there really are. There are time horizon issues, but if we think every time we see a environmental degradation, it's a time horizon problem instead of primarily being an externality problem, or if we see excessive shareholder primacy and think of that as a time horizon problem as opposed to a purpose issue, we're going to see and think that there's more time horizon short-termism than there is. So in terms of the target, one of the main targets which we're focused on is the time horizon problem. And by pushing purpose issues and third-party effects issues into the same ball, we get, I think, in the EY report, a confused result. So let me talk in just for 2 or 3 minutes that I have left on the just on the truncated time horizon problem. Just focusing on the time horizons itself, there are a couple of substantial difficulties in the report. One is its use of the academic evidence thus far. The evidence on the severity of a time horizon problem inside the large, at least American public corporation, excuse me, is actually quite mixed. With a research assistant, we went through the last dozen years of studies in the major economics and finance journals, and they're about evenly divided. You could pull something out because there's some things that seem to be more of an issue and other things that seem to be less of an issue. So you could do something with it, but it's quite divided. You could not read this and say there is a consensus that we have a short-termism problem. What's more is moving from the literature to policymaking requires that we confront a couple of issues that are quite deep and that the literature just doesn't and can't, for some of the reasons that Zacharias mentioned yesterday, can't address. So first, some of the things, even if we conclude, say, that quarterly reporting induces greater short-termism, part and parcel of having a public company will require some form of periodic reporting. It may not have to be quarterly, maybe it could be semi-annual. I don't have a particular brief for quarterly reporting. But once we get reporting, we're probably going to get reactions of some sort that deal with the fact that a report has to be put out. And one has to assess is how critical is this for quarterly versus semi-annual reporting? How critical is it for the structure and success of the large public firm? We're not going to have large public firms if we don't have public reporting. And this just may be a cost of having public firms. And if we want public firms, we may have to put up with some of this short-termism. So, if we have lights in our house, they're going to generate some excess wasteful heat. That doesn't mean we're going to turn the lights off. We're just going to deal with the problem. The second problem in going from the results to the to policy making is maybe even more severe. To really know whether we've got to have a policy reaction, we really want to know whether we have an economy-wide problem. So, for example, if we've got a definitive showing that when stock options vest, we get more short-term behavior in the firms when the stock options vest, that doesn't yet tell us whether we've got a severe economic problem that warrants addressing. So, for example, other firms whose stock options are not vesting at that same time may pick up the slack. So if the slack is cut back in R&D, if there are other firms that are not in the treatment category who can react, we could have significant mitigation. And it may turn out that in the end, we don't have a short-term problem that scales to the economy. So 2 issues are embeddedness and scaling, and these don't get nicely answered by the literature. Last thing that I'll just mention is even sometimes when we find some short-termism, we actually don't know whether the short-termism is good or whether the short-termism is bad. We usually have a negative connotation on it, but some elements of short-termism are firms adapting to new circumstances. And as everybody on this Zoom operation has thought of at one point or another, long-termism can be bad. A firm that has a long-term commitment to building and selling buggy whips does not have a long-termism that can be complemented. So we ought to be reducing even the short-termism that we do see as, do we need a policy response based on the question of how severe is it? Is there mitigation? Is it embedded? What portion of the short-termism is actually adaptability and flexibility? So our overall conclusion is where we started on the first slide. We've got a serious conflation problem in the report. There's poor use of the buyback evidence, which Jesse's going to address in a few minutes. There's poor use of the evidence overall, which is quite mixed, but doesn't show as mixed in the report. And there's poor planning on the purported cures, which Holger's going to talk about. Hence, our advice to the EU is watch out. Do not rely on this report for policymaking. Thank you.
Thank you, Mark. I think that couldn't have been clearer. So, Holger, over to you.
All right. Can you hear me? Can you see me with my slides? Excellent. Great. So I will continue Mark's discussion of our discussion of the EY report together with Jesse Fried, who's here, and Charlie Wang. I'm not going to cite many of the literature that we use in our reply. I invite you to check out our SSRN paper and to do that. I'm going to focus on the last part of our reply, which deals specifically with the reform proposals in the report. I'm going to try to address them mostly in their own right. So before I go to the details of the individual proposals, let me make two preliminary remarks. The first preliminary remark I want to make, just to remind you, it comes out of what Mark just said, that the corporate governance system is complex and it is not broken. And that means that we need to tune it with care. Why do I say that? If the system were broken, then we could just try stuff out because, I mean, if it's broken, then what can you do wrong, right? I mean, it can't be worse than broken, but it isn't broken. The corporate governance system does many very important things for us. For example, at the moment, the corporate governance system is helping us develop vaccines at an unbelievable speed, never seen before, dealing with the logistical problems. These sorts of things need to be carefully thought out. And so we need to, when we tune it, we need to make sure that we tune in the right direction. We might very easily tune in the wrong direction if we are not very careful. And so when I say not broken, I have to back that up. Mark already went through it, but I just want to repeat, the short-termism thing is really a red herring, I think, because the evidence in the EY report is an opposite, and Jesse will talk about that in much more detail. The more subtle evidence that Zacharias talked about yesterday, that, as Mark just pointed out, may very well just be a side effect of efficient corporate governance and not something that should trigger a large-scale reform. I'm not saying that as a definitive assertion. I don't think we have enough understanding of these phenomena for that, but I say it as a caution that when we act, we may be actually going in the wrong direction. Externalities are mainly addressed by regulation and taxation, and that is factually is the case. There's heavy regulation on all sorts of fronts, including, of course, environmental issues. And Oren Sussman yesterday explained why that is in general the best way to go, because we're then not limiting our enforcement to public firms. It's comprehensive and so on and so on. I'd say mainly because, yes, it is true that there's some issues that are not addressed, and perhaps they can be addressed by corporate governance. But again, we need to be really careful in how we do that. And just to preview something I will say later, the fact that externalities are mainly addressed by regulation and taxation means that those that are not addressed are probably the ones that are hardest even to measure, most controversial in how we should go about it. And so just kicking it over to corporate boards to deal with is a problematic strategy. Short-termism, second preliminary remark, short-termism, if there is short-termism, it is not a valid rationale for mandatory EU regulation. Why is that? Because unlike externalities, short-termism is primarily a problem for investors. And that means that you can let the investors decide with an opt-in rule. So even if you think that currently perhaps the rules available don't make it possible for investors to have a well planning a long-term firm, well, make the rules available and make it opt-in. And if investors think this is a good idea, they can do it, because it's mostly something that they will have to suffer through. You don't need mandatory regulation for it. Or at the very least, you can leave it to national regulators to decide. And in fact, under the principle of subsidiarity, I think this is something that the Commission would have to do if their reforms are going to be predicated on short-termism. Externalities is a different matter, but that's why Mark just explained the important distinction between these two things. All right. Having said that, now let me get into the 7 proposals that are in the EY report. And I'm going to focus on the option C for each of them, which is the mandatory, the hard reform proposals, because those obviously are the ones that are most controversial, and also the ones that the report generally favors, with one exception that I will get to. So the exception I will get to right away is the second proposal here, which is to incentivize long-term holdings and to prohibit earnings guidance and quarterly reporting. I put that in square brackets because the report itself claims that it would be disproportional to mandate this. And so I will not spend much time talking about it, except to say one thing. This incentivization of long-term holdings that also came up yesterday is a proposal, I think, that has a lot of surface plausibility, because if shareholders hold the shares for a couple of months, how could the firm be interested in long-term planning? But that is a fallacy. It forgets about the effect of share prices. Share prices take into account the long-term prospects of the corporation. If you don't believe me, look at Apple's stock price for the last, Amazon's stock price over the last decade or two. It didn't have positive earnings, but it had a sky-high stock price because of the prospect of future earnings. Same with Facebook and many other firms. And so that being the case, a short-term stockholder can generally only benefit if the long-term planning is good. Yes, theoretically, it's possible that sometimes in certain situations it doesn't work that way, but as a first cut, there is no problem from these short-term holdings, and it would be in fact very dangerous to go against short-term holders who are doing a lot of the work of checking that managers are doing the right thing. I'm a long-term holder. I own index funds. I don't do anything. Neither does my index fund manager. The people who do the work are actually relatively short-term holders, because once they've done something, they move on to the next project. All right. Let me move on to the next proposal. This is director remuneration. It's supposed to be long-term under this proposal. I put that in green because that's just fine. And that's in fact what the companies are doing mostly already. As Zacharias pointed out yesterday, it is far from perfect, and there's continuous efforts of fine-tuning and doing it better. So this is a good thing. It's happening already. I don't think we need mandatory regulation. If we had some, probably wouldn't be that big of a problem. Mandating sustainability strategies and mandating that director nominations consider sustainability. I put that here in green because to some extent this is happening already. This was pointed out yesterday. If it were mandated, I don't think it would be much of a deal. I mean, consider having a strategy that seems pretty, I mean, you know, whatever, what could go wrong? Maybe it's a bit of red tape. I don't have a big issue with it. Maybe it's even good. Maybe it focuses people on doing the right thing. We, I think, don't have a strong view either way on these things. Tying director remuneration to sustainability metrics and mandating stakeholder involvement. Now here it gets a little bit more dicey. And the reason is not that sustainability is wrong or that caring about stakeholders in principle is wrong. The problem is that the devil is in the details. And here the irony in the report is, even though it proposes this, it actually admits in the report that the authors of the report, have difficulty identifying who the stakeholders are and what the sustainability metrics should be. Now that's not really surprising because stakeholders are many. They might be in different countries. They might be customers, workers, whatever. They have conflicting interests. It's really hard to figure out who should be taken into account. We have some examples in our reply that make this very, very concrete. Sustainability metrics, if it were easy, we would have the regulation already. Again, make it concrete. Greenhouse gases. How many greenhouse gases should the company eliminate? All? Society can't get itself to eliminate even half. Some? How much? Most companies doing so is not so easy, okay? That's all we want to point out. Again, it's very complicated and the report doesn't even begin to discuss these issues. Directors' duties, and those should be enlarged to take into account stakeholders. That sounds good if you have in your head the myth that shareholder primacy basically mandates that directors torture babies in order to get the stockholder profits. That is a myth that is completely off. Yesterday, I think it was Georg Ringe who pointed out that in Germany, there's no case where directors were actually forced to do something bad for stakeholders because they had to favor shareholders. Well, even in the United States, there is no such case. There's one case from 1916, which is probably a feud between two shareholders rather than anything about stakeholders. Anyway, that's the only case, even though the United States very clearly follows a rule of shareholder primacy. When I say very clearly, I mean Delaware. There are other states in the United States that have a broader rule, broader view. They have constituency statutes. The evidence is that they don't actually make any difference, or at least none that is large enough that we can measure it. So therefore, our view is if one were to change these director duty formulations, it wouldn't make much of a difference. So we can't really say it would be that bad. We also don't think it would be very good, except if one were to make them hard enforceable, meaning one were to grant the rights to bring lawsuits. And that gets me to the last proposal, number 7, stakeholder lawsuits for violations of duties. Now, this one I think is toxic. It is dangerous. And to make that very concrete, again, this is not specific to stakeholders. We do not have an enforcement of the share of the director's duty of care in the world. We don't have legal enforcement, and the reason is that it is way too difficult for a court to figure out whether directors actually did something wrong in a complicated situation that directors tend to be dealing with. The evidence is quite conclusive. Around the world, there is no liability for breaches of the duty of care, except in some insolvency situations in some countries. And the reason, again, is the complexity of the issue. The only thing I'll say, and this is the last thing I will say, is if you find that surprising, we should think that in many other areas, for example, in politics or generally in government, we don't get to sue politicians or government officials who we think haven't adopted the right policies. And if you think that that comparison is far-fetched, well, under the kind of proposals that are being discussed here in the EY report, boards of directors would very much act like governments because they would have to balance all of these social concerns. And making that judicially enforceable, I think, would be a recipe for disaster. Thank you.
Thank you very much, Holger. Well, I'm very grateful that you went into the actual policy proposals in the report, because that's something that we've not discussed so far. So I thought that was a really great addition, that we have started a discussion on the actual proposals in the report. Now, we're supposed to have a break, but and we will, but I suggest that we have one question in the chat from Leila Melon. I think the question here is on a more optimistic note, is it actually good that these studies are out there now and they can be subjected to what one might call a peer review by academics? And I think Mark Rowe has given the answer to this, and Mark, you can contradict me if I say misinterpret you. I think the answer is yes, we're delighted, and that's why we are here, and people have in fact volunteered to spend time on this, because we all think by revealing of being here that these are actually important issues and these are important questions. That's why we're all here. So I think the answer is yes. But as Mark said, the question is, are we talking to a wall, or is there anybody listening? And we will find out over the months to come, I think. So with this, unless there are further questions in the chat, I propose that we do have our 5-minute, well, actually we have a 10-minute break. So we could have one more question or 2 more questions if anybody has another question in the chat. No? Okay, then we take our scheduled break and we reconvene. Oh, here's another question. Okay, I did not understand. Okay, I'll need to read that question. So we take the break now, and then we reconvene here at 3:30 Brussels time. So that's in exactly 9 minutes. So a 9-minute break. Thank you very much. So 30:30 in whatever time zone you're in. Okay, so welcome back to the second part of day 2 of our workshop on directed duties. And we now have a discussion, and we have 4 distinguished colleagues to intervene. We have, first of all, Jesse Fried from Harvard. Jesse's published extensively on things like executive remuneration. And as Mark Rowe announced, he's going to talk about a new paper he's written focusing on share buybacks. We'll then have Mark Gerschen from EE in Madrid. Mark has also published extensively on all things corporate governance. He also has a textbook on the subject. We then have Jennifer Hill, who is extremely committed because she's joining in the middle of the night from Australia. She is one of our distinguished law scholars, and she's also published extensively. And finally, we have Theo van Meulen, who's joining from INSEAD, and he is one of the world's leading experts on payout and share buybacks. So I predict that that might be a subject he'll be commenting on amongst other things. So Jesse, we start with you. Over to you.
Thank you for inviting me to speak. So I'm going to be talking about a paper that I wrote with Charlie Wang of Harvard Business School entitled Short-termism, Shareholder Payouts and Investment in the EU, which is basically a response to the EY paper. And what we find is that the EY's evidence of short-termism is severely flawed. So let me see if I can advance the slides here. So the first piece of evidence that EY points to is that shareholder payouts, dividends plus repurchases are increasing and high. In fact, EY ignores equity issuances, which move capital in the opposite direction and far exceed repurchases. Net shareholder payouts are actually quite moderate, and small EU firms, which are the fastest growing firms, are net equity issuers during the entire period of that EY looks at. The second piece of evidence that EY offers is that CapEx and R&D intensity have declined. In fact, investment intensity has increased. EY reaches its findings by looking at a flawed sample. The third claim that EY makes is that these shareholder payouts deprive firms of resources for future investment. In fact, cash balances among EU firms have been increasing. And our basic point here is that when the EU is trying to figure out what to do, that facts should matter. So we are very critical of Ernst & Young in our paper and also in the joint response that we wrote with Holger and Mark. But in some sense, the blame should begin with things that have been happening on our side of the Atlantic. We've had a very active policy entrepreneur, William Lazanik, who has been publishing heavily since 2000, basically making the argument that excessive share buybacks are making it hard for American companies to invest and pay decent wages. And his work did not get very much traction until about 2014, when the Harvard Business Review published a piece of his called Profits Without Prosperity. And then his influence skyrocketed in the United States and apparently also in Europe. So not only does the blame sort of start on this side of the Atlantic, but maybe it starts with Harvard itself. So let's first talk about measuring shareholder firm capital flows. EY looks at gross shareholder payouts, dividends plus buybacks. They ignore equity issuances, but if you include equity issuances, it dramatically changes the picture. So buybacks and dividends move capital from the firm to shareholders, but if you want to know how much shareholders are getting, you also have to look at equity issuances that move capital to the firm from shareholders, and equity issuances can be in the form of direct equity issuances to shareholders, like a rights offering, or they can be indirect equity issuances to shareholders where, for example, a company gives stock to an employee and then employee sells to public investors. That's economically equivalent to investors buying stock directly from the company and the company paying the employee. All of these equity issuances are functionally equivalent in moving cash from shareholders to firms, as Charlie and I explain in a 2019 paper. So let's look at shareholder payouts by EU public firms during the period of the study, 1992 to 2019. This chart shows total shareholder payouts, dividends plus repurchases in blue, repurchases by themselves in green, against a backdrop of net income. If you look at the last decade, 2010 to 2019, shareholder payouts equal 65% of net income, and the finding that we get from our data is exactly the same as EY's finding. So we've sort of matched samples with them, which is reassuring. But if you want to understand how capital is flowing between shareholders and firms, you have to look at equity issuances as well. This chart shows repurchases in orange, dividends in green, and then equity issuances in blue, all against a backdrop of market cap. You can see that equity issuances are substantial, not just in the late 90s and early 2000s when they peaked, but they're consistently higher than repurchases. And over this period, if you just sort of eyeball it, they look to be higher or about the same as dividends. So equity issuances are substantial. There's a substantial amount of capital movement from shareholders back to firms. This next figure shows shareholder payouts and net shareholder payouts by EU public firms from 1992 to 2019. The green series shows shareholder payouts, so that's dividends and repurchases. The orange series shows net shareholder payouts, so you subtract equity issuances. You can see that in the late 90s, early 2000s, net shareholder payouts were actually negative. So shareholders were contributing more capital to firms than they were taking out. During the most recent decade, 2010 and 2019, net shareholder payouts as a fraction of net income were only 38%, which is a little more than half of the 65% that shareholder payouts are a percentage of net income. So it's substantially lower when you take into account capital flows in the opposite direction. We also looked at small EU public firms. So this sample excludes the 500 largest EU public firms in every year. And you can see that in every year from 1992 to 2019, these smaller EU public firms were absorbing more capital from shareholders than they were returning, which is what you would expect. Small public firms are growing faster. They don't have as much. Retained earnings. They take in capital, and then when they get bigger, hopefully, and they become more mature, they can return capital to shareholders. This next figure shows the income that was available for investment by EU public firms cumulatively over the period 1992 to 2019. So we start with 1992. We treat that as year zero. What the green series shows is cumulative shareholder payouts. The orange series shows cumulative net shareholder payouts. The light gray is cumulative net income. And then the darker gray on top of that is adding back expenses for R&D, because net income doesn't tell you how much is available for investment because it's calculated after you subtract for R&D. So what's interesting about this figure is that you see that shareholders in the EU basically have been putting money into EU public companies until like 2013 when they started to take money out. It's not sustainable for shareholders to continue to put money into companies and not take money out. That's not how you make money in investing. At some point, you expect to get money back from the companies, and that's what seems to be happening, at least in aggregate, around 2013. There's a massive gap between the amount of income that's available for investment and net shareholder payouts over this period of time. So let's turn to investment. EY finds that investment intensity has fallen, but they do that by arbitrarily and inconsistently dropping firms from various samples. A better way to measure investment in the EU is to actually look at all EU public firms. And if you do that, you see that CapEx and R&D levels increased over the 1992 to 2019 period and over the last decade. And combined CapEx and R&D intensity increased over these periods. So let's look at aggregate levels. If you look at CapEx data in the EU from the early 90s, it's very unreliable. There aren't that many firms that are reporting CapEx, even though presumably they were engaging in it. The data gets more reliable around 2000. If you look at the most recent decade, which is when shareholder activism has been most pronounced, and there's been the most concern expressed about short-termism, CapEx and R&D together are up 23%. R&D is up 75%. A better measure of the tendency to invest is investment intensity, which is taking investment levels and dividing by revenue. In the most recent decade, CapEx and R&D intensity is slightly up. R&D intensity is up 30%, so there's basically been a substitution of CapEx intensity into R&D intensity, which is what you would expect in a world where intangibles are becoming more important than buildings and factories. Last point, how much money is actually left for additional investment should there be attractive opportunities? So EY makes the claim that shareholder payouts are reducing assets that are available for future productivity growth. But if you look at cash balances in EU public firms, they are rising. So the most important series on this figure is the solid green line. It shows cash and short-term investments held by EU public firms, increasing monotonically over this period. These companies have plenty of cash, and they can always issue more stock if they need more cash. Indeed, that's the whole point of a company going public, is so that you can issue more equity, as we have seen EU companies routinely do, especially smaller ones. So to conclude, contrary to EY's findings, actual capital flows to shareholders net of equity issuances are modest. Investment intensity is not declining, but rather rising. Firms are not being starved of cash for future investment. Cash balances are rising. And as Mark said, EU policymakers should not rely on the EY study. In fact, they should run from it. Thank you.
Thank you, Jesse. So I think that completes the full picture of your submission, and I think Mark gave a very good summary of it, which is at multiple levels. So first of all, the question, are we actually measuring the right, are we on the right target? Are we conflating things? And then you've just concluded that even if you look at short-termism within the logic of short-termism, the evidence that was presented actually doesn't support the fact that within the chosen metrics there is short-termism, which is of course a powerful conclusion. So we next turn to Mark Gergen. Thank you, Mark.
How do I share my screen?
There's a share button at the bottom. So it's a share screen.
I can't actually see that button. Oh, okay, I can now. Okay, can you see my screen?
Yeah, we can see your slides. Perfect. Thank you very much.
Pleasure. So I'm actually going to talk about sustainability rather than short-termism. And before I start, I would just like to reiterate some of the criticisms of the study. And I think over the last 2 days, we talked about the conflation of two issues, short-termism with sustainability. So I fully agree that there's an issue in the report about this. We also talked about the lack of empirical evidence or academic evidence being used in the study. And the kind of evidence that is being reported in the study is typically not the most recent study. And then finally, we had some discussion just now about whether there's short-termism, whether short-termism is increasing in the EU. And I think the general conclusion seems to be that that claim in the report isn't entirely correct. So what I'm going to do now is I'm going to focus on one of the drivers, driver 5. So this is one of the drivers that is supposed to increase short-termism in the EU over the last few years, and that's driver 5. And that driver 5 is about board composition. And if you read the narrative to this driver 5, there's a discussion about the lack of board gender balance. But if you then look at the proposed policy options as a result of this driver, none of these options mention board gender balance. So if you look at option A is about promoting the consideration of sustainability-related expertise in the board nomination process. Option B is more extensive. It's about ensuring that sustainability-related expertise is systematically considered in the board nomination process. And then finally, option C is the most extensive policy measure. This is about a new EU directive. We're just going to lay down rules on board composition to consider sustainability criteria in the board nomination process. So what I'm going to talk about now is board gender diversity. So why is board gender diversity important? Well, I'm going to discuss a recent study I've published in the Journal of Corporate Finance. And that study seems to suggest that board gender balance fosters sustainability. And we look at one particular aspect of sustainability, and that's the consumption of renewable energy by US firms. So my conclusion from discussion that is going to come is that it is probably easier to pursue and to reinforce the achievement of an existing target than, for example, changing board duties. So yesterday, we had some discussion about the proposed changes to board duties, and the general conclusion was that this would take a long time to achieve in practice. So the study I'm talking about is a US study. It's based on S&P 1500 firms, but at the same time, I believe there are parallels with the EU. The conclusion from that study would also be valid for EU firms. So what we do in this study is we look at a period from 2008 to 2016. And this won't be a surprise. We find a substantial increase in board gender diversity on boards. So if you're looking at the start of the period, there was an average of 12% of women on S&P 1500 boards. And by the end of the period of study 2016, that percentage had increased to 18%. What about the number of female directors on the board? Well, in 2008, it was less than 0.4. And in 2016, that number had gone up to about 2. The other thing which we observed during the same period was also an increase in the board gender diversity at the firm level. So first of all, if you look at the unbroken line at the top of the diagram, this is the percentage of firms with 1 female director. So that percentage increased from 25% in 2008 to 38%. The next line, the broken line, is the percentage of firms with 2 female directors. And again, you see an increasing trend. So we started off with 15% in 2008, and that percentage went up to 32% in 2016. And then finally, there's also an increase in the percentage of firms that have got 3 or more female directors on their board. So that percentage was initially just below 8%. And then in 2016, it increased to 22%. I tried to find similar data on EU companies, and the most recent data I found actually go back to the report by the EU Commission, which dates back to 2016. And I think an important point there is that some countries do very well. For example, France and Sweden. So they've almost achieved gender balance on boards of large firms. But then obviously, there's also some member states that are lagging far behind in terms of board gender diversity. So what we do in this study is we look at the consumption of renewable energy by S&P 1500 firms. So what is renewable energy? Well, we use data from Bloomberg, and these data pretty much follow the definition of the United Nations of renewable energy. So renewable energy is energy which is derived from the wind, the sun, biomass, small-scale hydro, but also waste sources. And what we do is we focus on the percentage of renewable energy in the total energy consumption. And obviously, total energy consumption includes renewable energy, but it also includes the lion's share, which is energy which is derived from fossil fuel energy. So what happens over this period is that there is an increase in the percentage of renewable energy. And what this diagram does is it distinguishes between firms with female directors and firms without female directors. There's an increasing trend for both types of firms, but the trend is much, much greater for firms with female directors. And even more importantly, the percentage of renewable energy is greater for firms with female directors. So why would women be more inclined to use renewable energy? Well, if you look at theory, gender socialization and also ethicality theories, they suggest 2 reasons why this might be the case. First of all, women define morality and ethics in terms of their responsibilities. And such responsibilities also include responsibilities of making the world a better place. What about men? Men define these 2 concepts about rights, their rights versus the rights of others. The other difference between men and women is in terms of helping behavior. So men's helping behavior tends to focus on very visible actions. So typically actions that could be classed or interpreted as heroic actions. And their actions also focus on the short term. What about women? Well, women's helping behavior is less visible. So it tends to be of a more caring and nurturing nature. And it also very importantly focuses on the long term rather than the short term. So what about the empirical literature on the link between board gender diversity and CSR? Well, that literature tells us that there's a link between the two. For example, female directors are more concerned about ethical practices and also socially responsible behavior. They also tend to reduce so-called negative business practices. So these are business practices that typically score negative scores from the CSR rating agencies such as KLD. They're also more inclined to take actions to reduce perceived risks. And much more generally, firms with female directors tend to increase their CSR ratings, which improves the firm's reputation. What about disclosure? Well, firms with female directors are more likely to make voluntary disclosures about CSR. And even more importantly, the market seems to value these voluntary disclosures more than voluntary disclosures which are made by firms without female directors. So I've talked about CSR in general. What about environmental CSR? So one specific aspect of CSR. If you read the literature, some argue that this is a highly relevant question. So there's a paper by Pearl Martinez and Stevens, and they argue that increased gender diversity, not just on boards, but in the workforce in general, is a necessary condition to transition to a more sustainable society. So going back to my question, the evidence suggests that the answer to this question is affirmative. So firms with female directors have better environmental CSR ratings, and they're also less likely to be subject to environmental lawsuits. So what do we find in this study? Well, we find that the percentage of female directors does indeed increase renewable energy consumption, but very importantly, there needs to be a critical mass of females on the board of directors. And we only find such an effect if there's at least 2 women on the board of directors. And then the other important thing which we find, which reinforces the existing business case for board gender diversity, is that the interaction of board gender diversity and renewable energy consumption actually increases firm value and firm performance. So is this about causality or correlation? Well, we try to prove causality by using 3 identification strategies. First of all, we use an instrumental variable approach, whereby we extract the exogenous component from board gender diversity. After doing that, we still find the same effect. We also do propensity score matching. So we match firms with 2 or more women with firms with less than 2 women. And finally, we look at what happens when a male director retires. So a male director was close to retirement age. And we distinguish between firms where the male director is replaced by a female director and firms where the male director is replaced by a male director. And we find that after the appointment of a female director, not a male director, there's an increase in renewable energy consumption. So to conclude, why look for new solutions to old problems if the old solutions work? Maybe not as quickly as we want them to be. But there's always a way of pushing that agenda of board gender diversity. But I think an important takeaway from this study is the need for a critical mass of female directors. So it's not just about increasing the percentage of firms with female directors, but it's also about ensuring that there's a critical mass of 2 to 3 directors, female directors on the board. So that's more to be done in some EU member states than in others. So that's clearly a conclusion. And again, as I said at the start of this presentation, changing directors' duties will take time. So why not stick to a current target and try and push that target? And that's all I had to say. Thank you very much for listening.
Thank you very much, Mark. So I think we now had an example of, if you start from the premise that actually what's our problem or what's the concern, if it's sustainability, why not try to relate sustainability directly to corporate governance? Why do that detour via short-termism? And I think Mark gave one example of a feature of corporate governance that policymakers clearly care about very much, which is gender diversity, and how you can relate that directly to a measurable sustainability variable, in this case, renewable consumption. Now, just as two footnotes to this, one is we had about 2 weeks ago a whole conference with the Swedish House of Finance with studies that try precisely to do that. And the sophistication that you have today in this class of research is amazing. People can now, with microdata, measure the energy consumption at plant level. So these are microdata sets that allow you to do things that are just simply remarkable. The second comment, Mark already mentioned causality. Zacharias mentioned this yesterday when you're talking about policy recommendations. Causality is very important. So Mark addressed this point. Third comment, and that goes back to the question we had on the previous panel, the inception impact assessment of the European Commission does mention, of course, very prominently the study we are discussing here, but it also has one reference to a meta study on ESG, so linking governance directly with ESG. So maybe the kind of study that Mark is talking about is actually finding some consideration, so which would be good. So with this little interim summary, we next turn to Jennifer, who, if she's still awake. You're still awake, Jennifer, you're here.
I am.
She is, not surprised, okay. Thank you for
so
joining
much,
from
Marco.
Australia.
It's a pleasure to be here, even though it is somewhat late or early, whatever. So I want to talk about the EY report, and I want to focus on some of those drivers. I'm going to be talking much more about sustainability, about negative externalities than I am about short-termism, but I agree that they are conflated in the report. So if I can just say a couple of things about, firstly, fiduciary duties and the formulation of directors' duties that Paul spoke about earlier. The study takes a potential stakeholder approach, and I think it's different, for example, to the UK stakeholder approach that you see in Section 172 of the UK Company Act 2006, because that is very much an enlightened shareholder value approach in the UK. But this one, I think, goes further and takes more of a pluralistic approach. And it talks about directors should properly balance the interests of stakeholders along with those of shareholders. So it doesn't seem to, bring shareholders out on top. And this, of course, really takes us right back to the, early 1930s with the Burley-Dodd debate, which has been presented as a clash between a shareholder-centred and a stakeholder-centred vision of the corporation. Now, the policy goal of issue 1.1 in the EY study is certainly a laudatory one. It is trying to provide, I suspect, a stronger framework for encouraging responsible oversight by boards and ensuring that companies don't make profits by harming stakeholders and by creating negative externalities. And in my jurisdiction, Australia, in the last couple of years, we have had some very cogent examples of this occurring in some major banking scandals. And these scandals were classic examples of a problem that Professor Don Langevort describes when he talks about competitive values crowding out compliance values and also responsibilities to society. And leading to, I think, in the Australian banking scandals, a sort of regulatory nonchalance. Now, the conduct of the Australian banks culminated in two quite important reports, one in 2018 by the prudential regulator, APRA, and one in 2019 by a royal commission that was set up to investigate the conduct. And the APRA report was quite interesting, I think, because it said that the ongoing financial success of Australia's largest bank, the Commonwealth Bank of Australia, had dulled the senses of senior management and the institution to the dangers posed by non-financial risks, and the non-financial risks were actually money laundering and counter-terrorism laws, failure to comply with them. The question is, does changing directors' duties to include stakeholder interests address this kind of problem? I suspect it doesn't, and I think it also, goes back to Professor Dodd's approach in the Burley-Dodd debate, where directors are given even greater discretion. And I think Holger referred to US constituency statutes that take a stakeholder approach, but it's worth remembering that those statutes were not introduced as a result of lobbying by stakeholders. They were introduced as lobbying by management. So it was seen as something that advantaged management. The other thing in the EY study that I think is notable is that it tends to set up this binary and irreconcilable approach to shareholder versus stakeholder approaches to the corporation. And there's this Manichaean divide, that shareholder-centred is bad, stakeholder-centred is good. And I don't think this is a very helpful way to look at corporate law. I think, as was said earlier in this session, there are really two fundamental problems in corporate law. And one is an agency problem between shareholders and managers. And that's one that we've become very familiar with over the last 30 years or so. Financial performance of corporations, it matters. Particularly in an age where many investors around the world are involuntary investors. They have their investment is through their mandatory retirement savings schemes. So corporations need to make profits. But the second problem is how they make those profits and whether corporate conduct is socially acceptable, whether they make it in socially acceptable ways, and whether they create negative externalities and harm to society that needs to be addressed. And I think corporate governance in recent times, we're very much focused on the first problem, but there is greater acceptance now that focusing too much on the first problem can create perverse incentives that exacerbate the second problem. Now, can fiduciary duties fix that? I suspect not. But it's worth noting that fiduciary duties are not standalones in creating guardrails to the way that directors behave and management behaves. Corporate governance today is very fragmented. Professor Ron Gilson talks about it being a braided framework. And within that braided framework, sure, fiduciary duties are important, although probably not that important, given we've learned they're very rarely enforced. But there are many other mechanisms that are pressure points on boards and on management. And these include mandatory laws to deal with externalities, which Professor Dodd ultimately came around to the view that that was a better way to deal with these problems. And also corporate governance codes, which have proliferated around the world since the early 1990s. And those corporate governance codes, I think, exist side by side fiduciary duties and can inform fiduciary duties and interact with them. And increasingly, those codes set up powerful norms in terms of how directors and officers should behave in terms of making profits in a socially acceptable way. So that's fiduciary duties in the report. The second aspect that I want to talk about is institutional investors. And certainly I agree with Paul Davies very much that coming out of the global financial crisis, there was a schism between jurisdictions that viewed shareholders as part of the problem that had caused the crisis. And I think the US fell very much in that category, as opposed to jurisdictions that thought the problem was that institutional investors had not been sufficiently active and that they needed to do more to be a constraint on reckless risk-taking. And jurisdictions that adopted that latter approach, I think very much the UK, my jurisdiction, Australia, and also from what Paul was saying, the EU. Now, the EY study, I think, takes the view that institutional investors are the problem, not the solution. And I think that that's potentially misguided. The growth of ESG interest in and focus in shareholder stewardship codes is very notable. And Paul has written on the way in which the 2020 UK Stewardship Code has very much turned towards including ESG issues in it. Also, on the ground, I think there are some really interesting recent case studies of institutional investors getting involved because they are extremely unhappy with the way profits are being made, and that they're being made in a way that creates problems for society or for stakeholders. And I've got a couple of examples of this that have just come up recently. So Dr. Hans-Christoph Hirt, who's Executive Director of EOS at Federated Hermes, recently gave a very interesting talk at Monash Law School, where he discussed an intervention by UK institutional investors at a shareholders meeting of a Chinese company, Honhai, after the institutional investors became aware of disturbingly high levels of suicide by young workers at that company. Secondly, in relation to climate change, BlackRock and the Norwegian Sovereign Wealth Fund have both stressed that they regard climate change as a major investment risk. And Michelle Edkins, I think a couple of days ago, there was an interview with her where she was talking about BlackRock's engagement strategy regarding deforestation and climate change. And thirdly, there was a very interesting, a multi-jurisdictional example of institutional investor activism in Australia in September. It was an example of UK and Australian institutional investors getting together to intervene in Rio Tinto's affairs after Rio Tinto had basically blasted the Juukan Gorge in Western Australia. And that resulted in the destruction of important Aboriginal cultural heritage site. So nothing really happened about that, apart from an apology by the company, until September, when it appears that the Australian superannuation or pension funds really pushed the UK institutional investors to intervene. And they did, and it resulted in the removal of the CEO and other senior executives. And I think it's a good example of Gilson and Gordon's agency capitalism on a transatlantic or a transnational basis of the local institutions getting the international institutions on board. I don't want to say anything about executive compensation. I think I totally agree with what Holger has said on that. So I'll just finish off with a couple of comments about the low level of private enforcement of directors' duties in issues 7.1 and 7.2 of the EY study. And in theory, at least, if fiduciary duties matter, you would expect that they should be enforced, and that enforcement is important as a deterrence and accountability mechanism. But it does seem from the report and from what the commentators have been saying that they are very rarely, these duties are very rarely enforced in the UK and in the EU. And that's also true, as Holger said, and Jack Coffey yesterday, in the US, certainly in terms of the duty of care. So it has to be something that goes beyond gross negligence in terms of monitoring failure by the board. That may be changing to some degree. There are a couple of interesting statements in the Delaware Supreme Court by then Chancellor Strine recently, or the last couple of years, where he suggests that there could be liability for directors where the company's whole business strategy is to inflate profits by circumventing or flouting public interest type legislation. So protective legislation, environmental or food safety legislation. The UK it's in flux to a degree, because it's been said that there has been an accountability firewall in the UK. But this may change with the introduction of new senior managers and certification regimes, which have also been adopted in some other countries, such as Hong Kong, Australia, and I think Ireland is introducing it. And that has a highly prescriptive regime to provide a clearer roadmap to responsibilities within financial institutions. And Holger mentioned that, you know, the duty of care isn't enforced anywhere in the world. And there is one place, my jurisdiction, it is enforced quite vigorously because we have a public enforcement regime. And it's the Australian Securities Regulator that enforces the duty of care and enforces the duty of care in public companies. And Dr. Jennifer Varzali has found that directors of Australian public companies face a 0.08% of being named as a defendant, which is quite a bit higher than in other jurisdictions. So I'm going to leave it there, but I would just say we are all having this by Zoom as a result of COVID. And, you know, there have been a lot of public company bailouts effectively around the world due to COVID. And I think we will see greater emphasis on public responsibilities of corporations going forward. Thanks, Marco.
Thank you very, very much, Jennifer. So let me just reinforce one point that you made, which is about, is this whole debate a bit out of date as far as public markets are concerned? And what I mean by that is that you correctly said that we are observing more funds flowing into index funds. We are seeing, especially in Europe, more funds flowing into what Hart and Zingales call pro-social active investors, and you mentioned some of them. This is not just true for retail funds, but also for funds invested by pension funds and other institutional investors. And so are we talking about the right thing here? Because when we talk about responsible investment, we are talking about some of the issues that you mentioned. It's access versus voice. Can we strengthen actually their voice? What about private markets? Can we strengthen engagement? And even hedge fund activists have recently started to engage on green. So yeah, is this whole debate actually in that dimension a bit out of date? And you know, it goes back to the conflation point. Anyway, so let's turn next to Theo van Malen. Theo.
Thank you very much. I have to share my screen. God. I don't know where's. All right, can you see the screen?
Yes, we can. Thank you.
Okay, very good. Thank you. I'm sorry. Well, thank you very much. I'm the residual claim holder. I'm at the end here, and every time when people invite me, they expect me to talk about share buybacks, and I will not disappoint you about this. And this report actually provides a great opportunity. When I read this report, I got deeply disturbed because I thought that the buyback derangement syndrome was confined to the US and to Harvard, but it now is coming to Europe, and it's pretty disturbing here. And it leads to some kind of meaningless measures of short-termism and making the link to buybacks as one issue here. And what's deeply concerning is that the buybacks are being criticized quite a lot around the world, and from left and right, mostly from the left. And I hear that Elizabeth Warren is planning to outlaw buybacks in America, and she may give bad ideas to Europe. And this is terrible for me because, you know, although I've written about 15 papers on share buybacks, so this may actually kill my research agenda if this happens here, apart from the big negative consequences for governance. The second point I find critical is basically that on the one hand, we've been told that, you know, companies care too much about short-term shareholder value, and they should care about long-term shareholder value. But then if you look close at this report, I think the report kind of says you shouldn't really care about long-term shareholder value. It should all be about stakeholder value. So let me go a little bit in the meaningless measure of short-termism, essentially, that you can, page 9, it says that short-termism can be judged by comparing payouts with investments. Of course, clearly that ignores the fact that when a company pays out cash, the money gets received by investors and is going to be reinvested elsewhere or going to basically be consumed. It also, as Jess has pointed out, ignores that companies can use external finances, not because a company buys back stock that is not going to be able to issue equity later on. And the whole debate about this trade-off between payout and investments always assumes that the payouts are missed opportunities of good investments. There are good investments and there are bad investments. When they're bad investments, you shouldn't invest, and maybe then you should pay out excess cash here. Our buybacks missed investment opportunities, and I just came across a presentation of Bill Azonik, the professor that is really responsible for this, but he's not a finance guy, he's basically a policy professor. And he essentially, in his presentation that he made at the commission, he points out that the largest buybacks during the last 10 years were made by Apple and Exxon. Now, the question is then, of course, should Apple have invested more? Should we have the iPhone 13, 14, 15, 16? Would shareholders be better off if that's the case? Would society be better off? And more interesting, should Exxon have drilled more and not repurchased $160 billion worth of stock? I mean, I don't think that shareholders today would have been happy if they had done that, given the low oil prices. And how is that consistent with the EU sustainability agenda? Maybe if the EU wants to outlaw buybacks, they should make an exception for all the non-sustainable industries. They should encourage buybacks of oil and gas companies, preferably with borrowed money, so that they all go bankrupt and then we reach their green goals much quicker than otherwise. What always surprised me in all of this research that compares investment with payouts is that they're assuming that outsiders, consultants, academics, regulators, and politicians can judge underinvestment. I think if you're not there in the boardroom looking at the net present value of the cash flows, then how could you decide whether buybacks are good or whether an investment is good or bad? So I think there's always the assumption that investments are good. Another illustration that shows this is not the case, if you look in 1999, internet companies did not buy back stock or they didn't pay dividends, they issued equity and invested a lot. According to the EY report, this should be the ideal companies that actually give the real example for creating long-term shareholder value. And on the other hand, old economy companies, mainly small value stocks, bought back stock in frustration. They say, nobody loves us, we're really deeply undervalued, we have great prospect, but nobody believes us. Now, who won in this battle? Well, this is actually a small experiment that I did, which, and I'm going to focus here on 2000. 2000 is essentially the year when I form a portfolio. I form a portfolio in January 2000, based on all the companies that announced buybacks in 1999, when the internet bubble was really rising very strongly. And so I'm holding this portfolio, roughly 50 stocks, small value stocks, and I'm holding them for 3 years. 3 years is the red box, and the shaded box is 4 years. So if you held those stocks for 3 years, you beat the market by 110%. If you basically hold them for 4 years, you beat the market by 150%. You can actually repeat this experiment every year from 1992 to 2002. So every year what I do, I buy the small value buyback stocks that announced the repurchases in the previous year, and I hold them basically for the next 3 or 4 years. And in each case, these companies actually do better than the market. So the whole idea that firms that buy back stock actually destroy long-term shareholder value is simply inconsistent with the data here. Now, this is not a kind of scientific study, and maybe we should move more to studies that are more precise and with better methodology. So let me a bit longer talk about the long-term consequences of buybacks. I think the authors of this EY report have not really essentially read the literature on share buybacks. The only thing that they read is really the anti-share buy papers of Lazonik. And Lazonik is really about This guy is really about that buybacks. It's not about underinvestment. It's really about the fact that when a company buys back stock, it uses cash it could give to the workers. It's really kind of a redistribution argument. It's nothing to do with underinvestment. So I would suggest to the next time that people read some good papers. And of course, I'm pretty biased in mentioning this as a good paper. It's a paper I wrote with Alberto Monconi and Urs Speyer. It's published in the JFQA in 2019. Is it a good paper? Well, the JFQA call it the best paper of 2019, so maybe then it's a good paper. And it looks at are buybacks good for long-term shareholder value, evidence from buybacks around the world. So this is one of the few papers together today actually with Jesse, which is one of the first papers that really deals with buybacks on outside the United States. And the study is basically based on 20,000 buyback announcements that were made between 1998 and 2010, and about 13% are from Europe. In Europe, buybacks are not that frequent, and one of the reasons, or at least the announcements are not that frequent, is because in Europe, the shareholders have to approve a buyback, in contrast to the United States, where the board members have to approve a buyback. So board members can quickly respond to, let's say, undervaluation of the stock and basically taking advantage of mispricing. While in Europe, you basically have to ask authorizations for share repurchases for the next 16 months or next 18 months during shareholders meetings. It's very unlikely that companies would call a shareholder meeting just to announce a buyback. So on average, basically, there's no evidence that, at least on average, of course, on average doesn't mean it's true for everybody, that the buybacks are a short-term stock price earnings per share manipulation scheme at the expense of long-term shareholder value. And this is basically shown in this graph, which looks at long-term performance of companies announced buybacks in around 5 regions around the world. So one region essentially is the green box, with this America ex-US, with this listed Canada. The red is Asia Pacific ex-Japan. You have then essentially the United States in blue, and Japan and Europe coming at the end. So what you see when companies buy back stock, they typically do it after they have experienced a decline in share prices. They kind of get beaten up in the market, possibly because they have a bad analyst report and they miss earnings forecast. But then they kind of say, well, this is a short-term problem. In the long term, things look good. So think about basically saying that they're good for long-term shareholder value because they show confidence in the long-term prospects of the company. So it's not a short-term view, it's just the opposite. It's a long-term view. Is they say the short-term doesn't matter, what happens is the long-term. And it's a commitment to shareholder value maximization because, and I think that explains the hostility to buybacks, because buybacks are the ultimate capitalist activity. Essentially, the workers don't like it because they prefer that you use the cash to increase the salaries. The bondholders don't like it because you increase the risk. A lot of managers don't like it because they prefer to become a bigger company, make an acquisition, and possibly get a higher, get an acquisition bonus and get a higher salary. So clearly, that explains the hostility. I think it has nothing to do with underinvestment. It has to do with the aversion to capitalism. It's really driving this anti-buyback wave. Of course, there are bad buybacks. As was mentioned yesterday, there were some cases where you can manipulate earnings per share if bonuses are based on EPS. But I spoke to some board members and I said, well, what we do, we change the way EPS is calculated in bonuses. What we do, we add back the interest to earn on the cash that was used to buy back stock, and we keep the number of shares the same as before the buyback. Or better, you should not use EPS as a target, really. It's a bad idea. And of course, a buyback is bad if the stock is overvalued. People have criticized it because, listen, before the crash, all those companies bought back stock. You were overconfident, but that's the same concern with other investments. I mean, it's not that buybacks are making an exception here. When American Airlines essentially was criticized recently because they said, you bought back so many shares before the COVID crisis and you have no cash to how in your company. Well, would they be better off if they had bought more planes? I don't think so. And you can't afford buybacks. That's another critique, is that you'd increase leverage above the optimal level. But that's the same concern for other investments. When you make an investment, you should kind of care about making sure that the capital structure is adjusted to the investment. So there is nothing peculiar about that buybacks in some way are worse than other investments here. Now the last thing is about the other item in the report is the basic inconsistency. They say, well, we focus too much on short-term shareholder value, so boards should focus on long-term shareholder value. But then on page 37, it says that, you know, the goal is not really to maximize shareholder value because the prominence of shareholder primacy leads board members not to take sufficient account of the long-term interest of stakeholders, including society at large and the environment. Now, again, this is essentially embracing a stakeholder view. And my view here is when are sustainability goals and long-term shareholder value consistent? When it's a win-win situation. Your customers care and buy more of your products. Your workers care and show more loyalty, accept lower salaries. The government cares, taxes you less, and gives you subsidies. And maybe your investors care and your cost of capital goes down. So all of these things tend to increase shareholder value. So if it's consistent, then that's the fundamental question. Then indeed, the sustainability goals are consistent with shareholder value. When they're not consistent, then there is a trade-off. And then the report goes about we should balance the interest of various stakeholders. How in the world are you going to balance interest of stakeholders? How can you balance something that you can't measure? Essentially, what happens is then stakeholder value maximization is really about politics, encourages arbitrary decision making. I can give $1 million bonus to my CEO and he's better off, he's a stakeholder, and then there's 10,000 shareholders that lose $100. How could I prove that stakeholder value is not maximized? Why would the happiness of the CEO not be bigger than the unhappiness of those 10,000 people? And I think the board is appointed by stockholders, not appointed by society. The society takes care of politicians. Politicians are appointed by society, and the politicians have their role to play, but the board has a responsibility with stockholders. And an ethical board should respect that implicit contract it has with its shareholders, because the stockholders have no one else to protect them. If I'm buying shares, what are my protections? A bondholder has covenants, a worker has employment laws, and a customer has guarantees, but a stockholder is a completely left over at the mercy of the management. Someone has to protect the stockholder here. And I think what this report tried to do is saying, well, shareholders do not really matter. It's all about externalities and stakeholders. So therefore, I care about sustainability, but I care about the sustainability of capitalism, not just about the planet. I just want to ensure that capitalism survives because it has been a great source of progress for society. And I think that should be respected. So that's my final word. Thank you very much. And I hope, again, that the next report will be better because another report and it will incorporate criticism. What I cannot believe is that they have a report. They ask people to comment on this report. And then they do not take into account the comments. What kind of people are these? They're paid by taxpayers. They're paid by me, not by you from Australia. But they paid by me. And basically, why are they not listening to us? We pay their salaries. And we should have an input. And if we say this is a junk report, then they should have the conclusions and reject everything what is said in here. Thank you very much. It's been a great pleasure.
Thank you very much, Theo. So as we discussed before, we don't know yet what the answer to your last question is because the European Commission is in listening mode and everything you've said has been recorded. Now, let me maybe pick up one point of the many points you made, which is again about conflation. So I think you made two important points there. One point is that, of course, if you talk about long-term versus short-term, that doesn't tell you anything about the distribution of cash. And one point that's implicitly made is that more money should be paid to employees. Now, that is a point about equality, and it's definitely inequality. It's definitely a point worth discussing. But then, of course, there are questions about what's the result for company performance, et cetera, et cetera. Another point that you made is even if you decide on this and you have less payout and you pay your employees more, that's not a guarantee that you're going to improve sustainability. If you have a carbon company and you pay the employees more, that doesn't mean that they are going to be more engaged in making the transition to cleaner energy. So again, this is a point that is, you're not really hitting the policy objective straight on the head. So I thought that was one of the important points that you made. So we now we are almost we are 5 minutes. We're running 5 minutes late, but we had budgeted a bit of buffer here.
Sorry.
So we have until we have 15 minutes for questions and answers, and I have in the Q&A. So people who are attending, please, if you have a question, type it into the Q&A. I have one question here from Maria Pia Sacco, and the question is whether the statement is, there's a statement which is that the EU is preparing mandatory legislation, so mandatory rules on human rights and environmental risks, and then don't director duties have to take that into account anyway already. So if we have that, do we need to do anything about this directly in terms of corporate governance? So maybe I give this to Jesse.
To me?
To Jennifer.
Okay.
I'm not sure that it was a question. I think it was very much taking the view that once these sorts of mandatory changes occur, that can then affect directors' duties and the duty of oversight. And I would just say, I mean, I didn't have much time to talk about the public enforcement of the duty of care in Australia, but it's quite interesting because there has been growth in what's called stepping stone liability. And that's a two-step liability for directors if the company breaches a provision, say, of the Corporations Act, and that results in significant harm for the corporation, the directors can be liable for breach of their duty of care in allowing that to occur. And so you can have that kind of two-step liability in Australia for the duty of care, but I suspect not in many other jurisdictions.
Oops. I think this point is very well taken. I think in the kind of Friedman view, if you have regulation and ethics, then the company will maximize, even if it maximizes shareholder value, that there's no problem. So that's the kind of enlightened shareholder value approach that we've been discussing. But that assumes that the regulator is in fact going to do what's necessary. And of course, if you're talking about global problems and you have multi-jurisdictional problems and prisoners' dilemmas and market failures at a global level, then of course we can't take that for granted. Okay, so we have a question from Eva Michela. Given that there's not much negligible enforcement of directors' duty of good faith, to what extent does it really matter if we broaden the scope of duty? So I think that goes to you again, Jennifer.
Well, I do think that if you don't enforce the duties, it really doesn't matter what it says. And the idea that you have the duty of care on the books in the US, but it can't be enforced because of the business judgment rule and exculpatory clauses in charters really, undermines it. I was quite interested in what Holger said because it was slightly different from what I understood Holger's position to be a couple of years ago, which was that it wasn't necessarily a good thing to have completely unenforceable duties of care, that there could be ways of having some consequences for breach. But we've lost Holger, so I can't throw that back to him.
Well, he's still online. So
oh, he's online, Holger. Yeah.
So can I then invite, maybe throw it back to the beginning and ask Paul, Mark, if you have any comments on what was said after you've spoken, and Holger, if you're still there.
Could I just say something? Sorry.
Paul, yeah, please go ahead, Paul. Yeah.
Me first. Just say something about that last point about enforcement. I think the Commission's aware enough of this particular point that an enforceable duty is not much change from a duty cast in a different way if it remains unenforceable, which is why I think they're proposing to give stakeholders the locus standi to enforce fiduciary duties. So it's not just that there would be a reconfiguration of the substantive content of the duty. There would also be an expansion of the range of people seeking to enforce the duty. And that, I think, is something I think Holger has indicated, which would require very, very careful handling. Otherwise, you'd end up with a highly politicized board decision-making process, and the company being involved in litigation most of the time. But I don't think it's fair to say that the Commission has missed the connection with between reformulation of the duty and enforceability of the duty.
So I have a question from Vanessa Knapp. I think it's a very important question. I don't know yet who will answer it. So I'll read it to you first. So there is agreement that the study is flawed. So don't we need to concentrate on what the European Commission should be doing, as they seem to have committed to taking action? How can we best share the concerns aired in the last 2 days? And there are more coming tomorrow, may I say. What should we suggest they do? So Paul, since you were on the line, maybe you.
Well, this is phenomenally difficult, isn't it? Because the Commission doesn't seem to be in listening mode at the moment. It seems to be in the mode of pushing through a set of objectives which it formulated some months ago, and is not much interested in being deflected. At the end of my talk, I suggested that maybe there were other participants in the EU legislative process who might be more open to these sorts of arguments, in which case I think it's a question of marshalling arguments and data which already exist, as we've seen very clearly today and yesterday, and presenting it to the non-Commission participants in the legislative process in the hope that they will make good use of it.
Yeah, so I think the general answer is that everything we've said is on the public record. We will make all the proceedings available, the papers, the recordings, etc. And we will see what will be picked up. I think also people who are here clearly showed an interest. So if a follow-up is desirable, I think people will make themselves available. And as Paul said, I think first of all, we don't know yet what the European Commission is actually doing. So let's give them the benefit of the doubt, because the impact assessment and better regulation is something that was put in place with a purpose. And let's just assume for the time being that they actually mean business with the impact assessments. And then secondly, even if not, I think there are other people who still, and other entities that still have to intervene before actually something becomes legislation in this very important area. So we have I think we can take at least one more question, and we have one from Frédéric Barge. So he says, and okay, I hope Holger is still here because it goes to him. In Holger's presentation, he stated that the approach of the EY report on executive remuneration was the least to contest. To what extent is there support from the speakers of today to install more guidance on executive remuneration? And does it need regulatory intervention from the EU in your view? So I hope you're still there, Holger.
I was there all the time. I was just frantically searching.
Okay, very good. So over to you.
So, I didn't want to give a brief for a mandatory intervention because, as I said in my preliminary remark, to the extent that, for example, remuneration structures hurt the investors themselves, it strikes me that there is no need for a mandatory regulation. They will figure it out. Now, Jesse has written an entire book about what can go wrong when you try to figure it out. So, maybe on the fine tuning, but then now we're going really into the details at a level which I think the report hasn't even approached. All I wanted to say was, since long-term compensation, at least in principle, is a good thing, if you were to write it into a statute, you probably wouldn't be doing much harm. It is possible that given some other frictions, you might be doing something good. And so we just, I think Mark and Jesse are there. They can speak up if they don't agree with me. We just thought that was a relatively harmless proposal to put out there, in contrast to some of the other ones.
Marco?
Luca, yeah. So you have a question, or you want to do the concluding remarks?
No. I have a question from someone else. That is,
okay.
Man Banerjee apologized with you for writing too hastily a question before the break, but then he wrote a more elaborate one, which Holger expressed the desire to respond. So I thought I may read it and leave the floor to Holger. So the idea that there are corporate problems that should be externally regulated by the government or oversight authorities, and there are some problems like short-termism that should not be under the radar of regulation. This is the idea. This concept is not clear to me specifically. Why shareholders cannot take care of all kinds of problems? Why not the government just look at the aspect of implementation of the contract between different stakeholders? Holger.
Well, I mean, it's funny, that actually goes to Coase's Nobel Prize winning idea that in principle, if everybody could contract with anybody costlessly, then indeed we wouldn't need any government regulation, because, for example, I think Jennifer mentioned the Aborigines holy site, I think it was, that was blasted by Rio Tinto. Well, if we care about it as humanity, we might have all contracted with Rio Tinto. And then it wouldn't have happened. There wouldn't have been any problem. But I think the truth is that even if 7 billion people on this planet care about this site and would be willing to pay Rio Tinto a little bit of money in order for them not to blast it, we just can't realistically contract with them. Same thing with environmental externalities, all of these things that you can't address. Now, the people who are in contractual relationship with the corporation, certainly the shareholders and the creditors, maybe the workers, maybe the customers, if they are sufficiently informed, they can look out for their own interest and strike the right kind of balance in dealing with the corporation. But those who are not in contractual relationship, generally, I think it's unrealistic to think that they could contract for their protection, and shareholders, to the extent that they are self-interested, won't do this by themselves. Now, we have heard already many examples of investors who, for various reasons, do at least not want to do the really terrible thing. That was another example that Jennifer mentioned. Those were investors who intervened. But I think it would be, I would say, foolish to rely on corporations and their shareholders to, by themselves, unilaterally take into account all the externalities that they might impose on other constituencies. And in fact, that's not the world we live in. I mean, we have very extensive regulation that is designed to address all sorts of externalities, be they environmental, financial, social, I mean, you name it. That's why we have these gigantic compliance departments and large corporations. And so that's why we can't rely on the shareholders to do it, unless they are being pushed by the regulation to do it.
Can I add something here? So I've been working a lot recently on climate risks and climate finance. And what we find is institutional investors, they care about climate risks because they understand that regulation will come. So they understand that their assets are at risk. So we document in a series of papers that they start engaging, they start caring about the risk. And in fact, if you look at the pricing of carbon risks, it's there. We look at option prices and we find that stocks that have higher carbon emissions, they have higher tail risk, right? So even so, of course, what Holger is saying is correctly right. We need to realize also that the market is paying attention to the risks in anticipation of more regulation to come. So it's in the inherent interest of shareholders to care about climate and related risks.
Excuse me, can I say something about this?
Sure, go ahead, Theo. Yeah.
Yeah, I mean, but you're saying this climate risk is really not is risk that the regulator is going to do things against you because you're basically polluting or whatever, or your carbon output. That's what you call climate risk. It's a risk created by the regulators who's going to impose penalties on people because they don't behave appropriately. That's the climate risk. You're not trying to forecast the climate, right? You try to basically say, I'm worried about the government going to hurt me. That's why I'm worrying about climate risk. That's because the government is a source of the risk. Is that what you're telling me? Is that the basic idea? That the regulators are the source of the risk?
I mean, it's clear that the regulator has to, start introducing regulation, carbon tax, cap and trade schemes, and so on. And in anticipation of that and the potential damage it will have to the value of some of the assets, investors, start pricing the risk. Investors start caring about it in the investment process. I think that's clearly what we find. Now, is it enough? Is it correctly priced? We don't know, but it's a risk that is on the radar and that is starting to get priced.
Right, thank you.
Yeah, I think we heard this at the Swedish House of Finance conference. People start to price your house. I mean, they know how good your house is, and they are taking into account the real risk. And it goes down to the level of temperature, where the house is located, or the asset, the plant, all these kind of things. So I think what Zacharias said is very important. So I think we have to draw to a close in a second. So let me say just one more sentence to Vanessa's question.
Sorry,
yeah.
Can you let Holger chip in one last time?
Holger wants to say something? Oh, sorry, Holger.
Oh, yes. So very briefly, I think Zacharias and I, we are not in disagreement, actually. In fact, and I think this was Theo's point, that what Zacharias is describing is anticipatory compliance with regulation that isn't there yet, but that will be there. It's expected to be there. So it's not, I don't think, Zacharias, your point was against my point that we need regulation to deal with it. We get the benefit of even having anticipatory compliance, which actually makes the regulator's job a little bit easier. But that just goes to show how important it is that we do have regulation. And I think Theo's question was pointing at, if we didn't have regulation, would they then change their behavior? And maybe a little bit, but I think we would see much less of a reaction, and it would be let's say, daring to rely on them just to think, oh, we don't want the climate to change. Let's change our corporate and investment behavior. That will be by itself not sufficient if there's no regulation, at least on the horizon.
So, Luca, before turning to you, let me just give one personal comment on Vanessa Knapp's question. What should the European Commission, be doing? And I think we heard some of the additional answers now, which is that there is a whole body of research out there, and ECGR has been putting this out for the last 12 months. We have new research on the direct relationship between sustainability, asset pricing, responsible investment, stewardship, exit, voice, purpose, stakeholder capitalism, all these kind of really important and pressing issues. All the research is out there, it's ongoing. So A, support that research agenda. They've spent a lot of money on research that's really not very useful. And B, actually make use of this research. We put it out there free of charge. We don't actually get paid for it. So at least use it and go and frame the question, and don't take something that a high-level group has said in 2016 as the gospel. Actually go and read what people are producing, and it's there. So that's my personal conclusion of Vanessa's question for today, Luca, and over to you.
Thank you, Marco. So I think that these first 2 days of discussion have sown some doubt, at least, that sufficient evidence has been presented in the EU legislative process so far, that short-termism exists. And today, Mark Rowe, Jesse Fried, and others have done their part. And the second point that has come out from the discussion is that short-termism, if it exists, is an unlikely culprit for the social and environmental issues that the world is facing. so that doesn't mean, of course, that we should not worry about the existential threats that we face as a living planet, and or at least as a planet inhabited by humans, and as societies based on the rule of law and democracy. But again, these are wider problems, and it would be quite naive to think that short-termism is at the root of them. And tempting as this may be, because I think that there is also a semantic reason why there is this contrast between short-termism and sustainability. In a way, one evokes the opposite or the other. So if you are short-termist, definitely you are not working for sustainability. But I would say that semantic evocativeness is not a good basis for effective policy making. It's also puzzling that there seems to be an implicit distrust of also long-term shareholder value creation on the part of the European Commission. Paul showed this when he made the example of how they have framed some of the questions in the consultation. And it is even more puzzling that this distrust is expressed at a time when ESG investing is on the rise, and it is on the rise also consistent with EU policies of no longer than 3 years ago that went in the direction of favoring this kind of shareholder approach. Clearly, we are facing important issues here. Sustainability is nothing that we should underestimate or consider second order. The opposite is actually true. We have actually, many of us have argued in these 2 days that corporate governance issues are second order. And what we should ask is actually in the face of these problems, gigantic problem that we have, is whether our response should be to throw at these problems anything that we have and see whether anything works. And this is intuitively wasteful in more than one sense. Perhaps we should rather reflect about what could really work and focus our energies on that. Unfortunately, it's understandable that this is not what is happening. That is not often how policymakers have to reason, have to do their job. There is, in fact, a temptation for them to use all-out tactics, which in this context means proposing what some call Me Too reforms. So there is a problem for everyone. I deal with corporate law. Let's see what corporate law can do about it. And so corporate law will do its bit because the threat that we are facing is so existential and serious. So I said that without any intention to conclude that none of that this proposal, the very proposal that the Commission has put out, do not deserve serious discussion. That's actually what we are doing in these 3 days. We are seriously discussing them, and we saw today already that some of the speakers expressed mild support about at least one of them. But what comes out of these first 2 days quite clearly is that, first of all, short-termism is not what justified this proposal, and that many of them, if not most of them, can have very serious consequences that may well be detrimental not only for short-term and long-term shareholders, but for society as a whole. Thank you for your attention, and I would like to thank all the speakers and Marco for their presentations, and Marco for leading the discussion. And so tomorrow, same time, 2:30 Brussels time, we will have our last day of contributions to the very important topics of this event. Thank you.
Thank you very much. Have a nice evening. Have a nice afternoon, and sleep well, Jennifer. And we'll see you again tomorrow.
Goodbye.